There's so much, right, even there, housing affordability, and then kind of the bigger, broader of what the White House does to help the U.S. economy and more Americans. There's Raphael Bostic talking about Fed confidence, 2% inflation, important to make sure that we have inflation under control. What's important, and a Jobs Friday, where it isn't a Jobs Friday, but we'll get that read. When you think about the U.S. economy, what is front and center for you?
Well, I think it's the paradox of having strong growth, but underlying weakness across different sectors and across different stratas of the economy. I don't really like the K-shaped format because it tends to signify that there are two groups of consumers. There are two groups of businesses. The reality is that there is polarization across the U.S. economy. Mm-hmm. Whether you're looking at certain income groups, not just the lowest income groups, but the median income groups, they are increasingly struggling with high prices. When you look at business investment, there is polarization between those that are focused on AI investment and those that are not. There is polarization between large businesses and small businesses that are struggling more in the face of some of these policy headwinds. So it's not necessarily a K-shaped economy as much as it is a polarized economy within which you're still seeing strong averages. Average consumer spending, still doing well. Average business investment, still doing well. Average GDP, still doing well.
What's that masking, though?
I think
taking the average is just that. It's the average. There are outliers.
Yeah.
And so what's it masking?
It's masking an underlying fragility in the fact that you have these narrow pillars of growth that I've talked about in the past. And I think if you bring it back to income, which is really the fundamental pillar of economic activity, that is where there is pressure. The income growth for consumers is relatively low. We're talking about 1% growth for real disposable income growth, while consumer spending growth is at 2.5%. That explains why the personal saving rate has fallen 2 percentage points since April and the early implementation.
There's nothing left to spend, to save, rather.
People are dipping into their savings.
Yeah.
They're using credit. And that's why I'm a little bit more cautious than others when it comes to this notion that there will be a lot of fiscal stimulus during the tax refund season. Yes, tax refunds may be higher, but what is this money going to be used for? Is it going to be used for spending or reimbursing some of the credit and replenishing savings?
Listen, we've talked with you too about the wealthier consumer, and you get into the A pillars or the 3A pillars. We had consumer sentiment come out today, improved to the highest in 6 months, largely propelled by wealthier Americans who have benefited from stock market gains. So, yay, good. We know the wealthier consumer is very important to the U.S. economy, but I am curious what was going through your mind this week. We were kind of talking about it amongst ourselves with the AI trade a little bit in question and some nervousness around that. We saw that play out. That has been important to stock market wealth, especially among the affluent. So I'm just curious, should we be a little worried that this could come undone this year?
We should be very careful about the potential of an AI bust. This is a real downside risk, and it's interconnected with other potential risks to the U.S. economy. We're seeing a great degree of focus on the fiscal situation. We're seeing a great degree of focus on pressures on the Fed. Why do these matter? Because they can suddenly lead to changes in financial asset prices. And we know how the financial market has been behaving over the course of the past 18 months. A lot of gains on the equity front, but also a lot of movements across different asset denominations, a lot of movements into gold when things are not going well, not so much treasuries and not so much the US dollar. So these are important developments, and everything happens together. And so if we are to see a little bit more of a downbeat sentiment in terms of the prospects for AI, and importantly, the return on investment, then that could metastasize into something that is worse for higher wealth individuals and their spending desires and spending capability if you see a negative hit on financial markets. It could lead to some businesses pulling back on AI investment. We saw just today the 4 largest hyperscalers are promising to invest a lot in the U.S. What if that does not materialize? Is there a downside risk there?
Yeah, Amazon just saying yesterday $200 billion. It's $60 billion more than analysts thought they would spend in 2026. So when you say we have to be careful about an AI bust, how does that manifest? What exactly does that look like? Because as Carol was referring to, it's been kind of a complicated week when it comes to really just tracking what these companies have done, or the stocks at least have done, because there's this concern about a SaaS apocalypse with the software as a service companies as a result of what Anthropic's Claude was shown to do this week. And then there's also the concern about some of the hyperscalers and spending. So when you say AI bust, what does that look like?
Well, I think we're seeing a lot of pragmatism right now. We're seeing this notion of economics of necessity. What is necessary to drive growth? Where are going to be the next avenues of growth? And I think not many people know, and very few actually know what the situation will be in a year's time, 2 years' time, when it comes to which sectors will be leading the way. We're in the midst of a technological revolution. There are always going to be excesses in terms of upside risks that are taken and downside risks that are taken.
So we're definitely in the midst of this.
We are in the midst of an AI technological revolution.
And it's interesting because Amazon CEO Andy Jassy told investors he's confident the company is going to see a return on its massive investments in artificial intelligence. Listen, these guys have fiduciary responsibilities, right, when they make these spends. So I guess to some extent, you've got to trust that whatever he's seeing, he feels comfortable enough to say that, right, and doesn't want to put his company or his share price or any of this at risk. But again, people will also say, well, these people are talking their books. I mean, like, this is a big thing for them. So it's a hard thing to kind of weave through to figure out what's really going on.
You know, when I say narrow foundation to growth, one thing that I find really amazing is that the announced investment in CapEx from these four largest hyperscalers is worth about $250 billion. Assuming that materializes over the course of 2026, and assuming only a fourth leads to stronger economic activity domestically, so that 3/4 are imported, not necessarily counted in GDP, that would lead to a lift of GDP of 0.2%. That's a significant boost from four companies, right? So that is where the narrow foundation to growth is lying. You're seeing a lot of growth that is reliant on a few actors in the economy, wealthier individuals and larger firms,
right.
And smaller businesses and lower income families are increasingly struggling. And where I start to worry a little bit is that we're seeing this bifurcation between the prospects for strong productivity growth, but not necessarily the accompanying income growth that usually accompanies a strong productivity cycle, and that's because of this polarized economy.
That's a great point. Like, if we're more productive, where's the income to go?
Usually that's the story. You get more productivity and more real wage growth. You're not seeing that right now.
Hey, just in the last 40 seconds we have with you, on any normal Friday at this time, we'd be talking about labor
How many jobs?
Right? Yeah. Well, what does your analysis tell you about the health of the labor market right now?
And just have about 30 seconds.
It's in balance, but it's a fragile balance because we've seen a historical negative shock to labor supply from reduced immigration. So we have a break-even rate that's close to zero, but we are seeing labor demand being hesitant. Business leaders that we speak to are very hesitant as to who they hire, what skills they hire for, and at what salaries. And that is downward pressure on income, which in turn will feed into softer consumer spending going into the rest of the year.